Hey, good afternoon, everyone. Today is January 27th, 2014, and bringing you another Monday market analysis. So last week we talked about, we ran through some setups, we talked about some broader market, and we talked about some specific swing trading opportunities. So I thought we would recap on last week and talk about some stuff going forward. I had a handful of traders mention that they really like the walking through of the trade, so we'll do some of that. I thought we would begin with looking at the ES and where we've come to in this rather large sell-off. So what I have here is the extension drawn at 1775, and the way I gathered that extension, the way I determined that anchor point, if we come back here and we see the low anchor, actually I'm going to remove it for the time being, we see the, actually I'm going to go back even further. If we take from lows to highs where we were really the middle to late summer of 2013, we pulled back into the September long at 1630 and then rallied, kind of came back, didn't really double bottom, we didn't really retest 1630, but we held that support level and then before breaking out. So this high is the anchor that I'm using to pull for the current extension, and it was also the anchor for the previous extensions. So that high on August 2nd was used, there we go, was used once at the October extension. It was used a second time in the December extension, and now it's being used a third time here at 1775. So when you're looking at, extensions can be a little tricky because we are overextended, because the market has moved in usually such a violent fashion. But what we have is the extension at 1775, and it's pulling off that same anchor. Now, one thing I'll also mention, and I'm going to remove this again so you can see this a little clearer. I'm going to pull up a trend line. When you have this this kind of wedge formation, inverted wedge, so to speak, where it's like it's a widening formation, that's definitely a very bearish sign in terms of, when it's the opposite, when we're really wide on the left side of the chart and we're making higher lows and then lower highs and kind of condensing, which you'll see me reference a lot in various swing trading opportunities, looking for stocks that are kind of making that pennant formation, tightening, because when they're tightening, they're kind of building steam, and then it's at that point, at the apex, that we get that burst, and usually a resumption of the trend. But when it's the opposite direction, like this, where we have the widening formation, it's typically a sign of bearishness. But going forward, I think we have a relatively good amount of support here, and we're starting to see a little bit of a rollover happening. And if I pull back my retracement and draw that extension back up, the 1775. Come on, there we go. 1775 is holding, so we have that failure point of 1759. Really, I'm using this low, this major swing low down here of 1754s. If that breaks, that would be my, indication to start pulling from highs to whatever the lows end up being, and then looking for larger daily shorts on the way down. Now, if we do get a bounce here at 1775, which I think we will, it's still okay to draw from highs to lows and keep that retracement in mind. You'll see that 1806s line up with prior highs. Back here, that's kind of the lower end of this what would end up being resistance up above. So even if we do get this bounce here at 1775, it could be short-lived, and we could see some resistance at 1806. So there's going to be a lot of opportunities here to get long at the 1775s on the smaller time frames, like the 15-minute chart, and then at the same time pulling up the daily short and then getting short or taking positions off or taking profits at that 1806 level. If I flip over for a minute to we'll just look at the SPY. You can see last week, really up until the big sell-off on Friday, we were looking at kind of this point of the support level and the uptrend line coming together and kind of acting as, you know, a bouncing off point or an inflection point. So typically what happens is if we don't get the assumed reaction, which is we're coming into support and it would be assumed that we would continue and get a bounce and then break new highs, the opposite move is usually rather violent, and that's what, you know, happened on Friday with all the emerging market news and things like that. But what we do have still below us here is another support level, which we've, you know, gravitated towards. So I'm going to remove the upper horizontal support, and if we go out a couple years, we can see that the trend line support is still intact on this larger uptrend. So this is, you know, a 2-year chart looking at the S&P. And we can see that, yes, we broke the, you know, secondary trend line, and we're really just coming into this, you know, a little bit more major support down here in the much so longer trend line, the longer uptrend line. So, you know, looking at the volume, it can be a little bit intimidating, as we had, you know, some very large selling days on heavy volume on Friday, and then even today some pretty strong volume. And, you know, you hear in the media and on the news and things like that, you know, that, oh, we're overdue for a sell-off. Well, typically when the media is talking about, you know, a sell-off or we're overdue is usually when the market gets faked out. And if any of you were listening to Marketplace the other day, Kai was talking about how, you know, the bull market, it was the, you know, 100 and such day of the bull market, and the very next day is when the market sold off. So typically when the media is talking about, you know, this great bull market, that's when you should have your red flag up. And when the media is talking about, you know, heading for the hills and selling all your stocks and everything that you're long of, that's when you should be, you know, looking to buy. I suppose one other thing we could do is take a look at the 50 moving average and the 20, and you can see how I don't look at this, as you can probably tell, very much, but you know, this is one of the first times we've been below the 50-day moving average in quite some time. It happened back here in June, and then in beginning of September and beginning of October. But you can see we kind of came down right to that uptrend line and touched it and then rallied. So, you know, there's a lot of opportunity here, I think, to the long side. And if we, you know, keep an eye on some of the individual stocks, the Apples, the Googles, you know, Netflix, Baidu, LinkedIn, Chipotle, Facebook, and then some of the other stocks that aren't as heavily traded, but just to kind of get a sense and get a feel of what's going on internally, you know, not just with the broader market. I think that'll give us a clue as to when a bounce might occur. What'll happen is you'll be seeing, if you pull up the nightly list after the close, pull up the list of 52-week highs and 52-week lows, you know, you'll see a lot of stocks that were making 52-week highs perhaps last week or, you know, early this week, today and tomorrow, that, you know, stocks that are still trending pretty strong, or stocks that were trending strong last week and just got knocked down by the market, kind of that, you know, rising tide lifts all ships phenomenon. Those stocks that were strong that got pulled back, they will all end up forming hammers on the same day, and that's a, you know, very clear indication that we're either going to, you know, rip the next day, or we're going to gap down because everyone thinks we're going to rip, and then, you know, the opposite effect ends up happening. So that's kind of an indication that I look for with some individual stocks when they're all kind of setting up in the same, you know, pattern. That's a pretty, it allows you to really identify your exit point pretty clearly. So I'll be looking at some buying opportunities here this week. If we go back to the TOS charts, I'm going to pull up the YM. There was only one day, Tuesday. It was a shortened week last week. Monday was the holiday. And Tuesday was really the only day where we had any follow through. If we turn off extended session, let's take a look at the daily. So we had 21st is what I'm looking for here. So this was the large body candle here was Monday, and then the inside bar was Tuesday. I'm sorry, the large body candle was Tuesday, the inside bar Wednesday, and then the gap down Thursday, and then the small gap down on Friday, so to speak, followed by the large sell-off. So that's kind of what the daily chart looked like. If we go to that 3-minute chart, and 3-minute, and go back to the 21st. 21st was really the only day that we had a nice break of lows. So again, what I like to do is to identify the first 30 minutes, the high and the low of the first 30 minutes, and then if we break out or break down from that 30 minutes, I like to put a sell stop in this case below the low, or I would put a buy stop above the high, and breaking the lows, just continue to trail my stop above highs until we either get some sort of double bottom, or we break the prior bar's high. So Tuesday was a good day for this this type of trading. This was good for about 21 points here, or let's see, about 250 per contract is what I had on Tuesday, because we got that sell-off and then some initial follow-through, and then taken out. Just if what I meant by the double bottom, you can see these two candles here both had lows at 39s. When we have that happen, sometimes that can be a little reversal signal, and we did break the prior. This candle was broken on the next bar, so that essentially got me out of the trade. We did go a little bit lower, but that's can be indication of a reversal, so I have no problem tightening my stop in that regard. If we have a just a large body candle followed by an inside bar, I'll just leave my stop above that the large body candle to give a little bit of room to chop around. And sometimes the market kind of moves forward and then breaks again, but we're really just trying to capture a portion of the move as much as we can while keeping our stop at a reasonable level. I mean, if we broke down lows below lows here, and I just left my stop up here at 05s at my entry till the end of the day, I mean, sometimes that that could work out. Other times, it won't. So it's you can't kick yourself for missing a portion of the move, or getting out too early. If we move over to, where did my slider go here? Here it is. We move over to Tuesday, or Wednesday rather. So now Wednesday was an inside day, meaning that the high and low of Wednesday was inside of Tuesday. So when that occurs, when we open up and we're inside the previous day, that's always a day that I like to use extreme caution. So I didn't take any trades on Wednesday, and you can see the chart is just all over the place. There's not really any consistency going on. But then Thursday and Friday didn't really amount to much. We gapped down on Thursday, and then the low ended up just piercing briefly, but we didn't really go anywhere. So using a 5-point stop, just immediately get taken out of the trade and move on. And then Friday was a little bit interesting because we did have the gap down. We broke highs here right at 9 o'clock, and then so I marked the first 30 minutes. We broke highs. We just pierced highs, and then immediately ripped down to lows, and then we ended up getting a halfway back right in the middle of the range, which those are pretty dangerous to take when we come back right to the middle of a range, because as you can see, we can go from the bottom end of the range to the top, back to the bottom, and you don't just want to be buying in the middle of that range. But once we had that breakdown, you can see the next retracement came right back up to that resistance level, that lows of the first 30 minutes. So you can see how some of these levels line up, and getting in when the market does do something like this where we pierce highs and then turn around and immediately go back to lows, and we're in this range, and then we break out of that range, that can end up being a very clear resistance level, as essentially the 1600 level ended up being on Friday, and then all through the afternoon we continued to sell off lower. So that's kind of a look at the Dow. Looking at some of the stocks we talked about last week, WTW is one I mentioned for a potential short, and we didn't really get that bounce all the way up to the resistance level, but we did start to sell off here on Friday and reverse back down to the downside. Lulu didn't really get any sort of bounce. And then PHI didn't break down from lows. So the fact that PHI, kind of that same widening formation where we made a high, then low, and then we made a higher high, and then we came all the way back down to support, this is not one I would be looking to short now when we break lows. And then gold we talked about, kind of moving sideways. We did pierce the high back here, so I do think there's some upside in gold. We kind of just touched underneath the uptrend line, but you can still see that the trend in gold is higher highs, higher lows, higher highs, kind of put in a horizontal support level here, and making its way higher. FONR never gave us an entry. I was looking to get long above the highs right at this nice uptrend line, and the market just kind of pulled it lower. DPZ had a nice pop on the I think that was Wednesday, the 22nd, but then once again, inside day, and then the market did pull it back lower. So essentially, it was out at break even on this one. Put my stop underneath the breakout bar, and then was taken out on the sell-off on Friday. And then IRE was the next one. This one was looking for a breakout and never got it. And then the last one, ISIS, we broke out, same thing like DPZ. We broke out and then immediately just kind of sold off and got kind of pulled down with the market. So not a whole lot of follow through last week on some of the swing trading positions. Decent day for the Dow trading. I know I had a handful of people write in saying that they really they really resonated with that kind of very simplistic approach. A handful of new traders in the VIP area, so I appreciate that. And if you do have any other questions or specific things you'd like me to go over in any of these videos, feel free to shoot me an email, tim@emoneymind.com. I also have I put an offer out there for doing a little bit of one-on-one mentoring, something I've done in the past. I really enjoy it, and it's been it's been very beneficial. So I set aside essentially four slots for this next month, and I had 3 people sign up and get get scheduled, and so I've got essentially one more spot. If you're interested in going through your trades, going through your trading plan one-on-one, I'd be happy to help, and in any way I can. So feel free to shoot me an email on that as well, tim@emoneymind.com. And we will talk to you again soon. I hope you all have a great week, and talk to you next week.